You see a Shell petrol station and it feels ordinary. You pull in, you fuel, maybe you grab a drink, then you leave. It looks like a simple business. But that small piece of land is sitting on top one of the most calculated business systems ever built. And it didn't start with oil, it started with seashells. In 19th century London, Marcus Samuel was not thinking about fuel, engines, or global energy. He was running a trading business, importing decorative shells and curios for wealthy households. It was a small operation, but it sat inside something bigger. The British Empire had created global trade routes, and people who understood this movement, supply and demand, they had an advantage. By the time his sons took over, the world was changing. Cities were growing, nights needed light, and kerosene was replacing candles and whale oil. Suddenly, oil was infrastructure. It was no longer just a product. Marcus Samuel Jr., he saw the shift clearly. Most people in that period, they thought oil was about production. Whoever drilled it, controlled it. But he understood something even more dangerous. Control the movement of oil, and you control access to entire markets. At that exact time, the oil industry had a king. John D. Rockefeller, through Standard Oil, he had built one of the most powerful business systems in history. He controlled production, refining, transport, and pricing. If you tried fighting him directly, you lost. So Samuel did not fight him directly. He changed the battlefield. Instead of competing in America or Europe, where Standard Oil was the strongest, he focused on Asia. Demand was rising there, and the system was less controlled. But there was a problem. Oil had to be shipped long distances, and it was expensive. Barrels moved around the Cape of Good Hope, taking time and money. In 1982, Samuel made a decision that looked simple on paper, but completely reshaped the business. He commissioned a tanker called the Murex. Hey guys, this was not just a ship. It was designed to carry oil in bulk, not in barrels. Then he pushed to get permission for oil tankers to pass through the Suez Canal. That single move, it collapsed distance. The route to Asia became shorter, faster, and cheaper. Within a short time, his fleet expanded, and oil began flowing through the Suez at a scale no one had seen before. At one point, most of the oil passing through that canal, it was moving under his system. He had outmaneuvered Standard Oil. You see, he had not defeated it. But he still had a weakness: supply. Shell at that point, it didn't control enough oil fields. It depended on buying from others, and when supply fluctuated, the entire system shook. Tankers sat idle, costs remained, and revenue dropped. At the same time, in the Dutch East Indies, another company was rising. Royal Dutch Petroleum. It had access to oil fields, refineries, and production capacity. They had supply, but they did not have the same level of distribution and global movement. Now you had two companies with opposite strengths and the same enemy. One controlled logistics and the other controlled production. Both were exposed if they stayed alone. By the early 1900s, cooperation began quietly, shared transport, and coordinated market strategies. This was survival. It was not something like a friendship. Then in 1907, they formalized it. Royal Dutch took a 60% stake and Shell Transport took 40%. Together, they formed a combined structure that allowed them to operate as one system while still maintaining separate identities. Guys, this was not a simple merger. When you look at it, it was a strategic alignment designed to balance power, politics, and economics at the same time. Dutch interests remained protected, and the British interests, they also remained protected. But operationally, they moved as one. From that point, everything changed. For the first time, they controlled the full chain: oil fields, refining, shipping, and distribution. That is the moment Shell stopped being a trading company and became a system. But even then, petrol stations, as you know them, they did not exist. Fuel was sold in tins. You bought it from shops, carried it, poured it yourself. There was no standardized retail experience, no forecourt, no pump. That only came when the car changed everything. As vehicles became more common in the early 20th century, the way fuel was distributed had to evolve. You couldn't run a growing transport system on tins and manual handling. You needed speed, reliability, and access. After the First World War, the world had already built the infrastructure for fuel at scale. Armies had depended on it, and vehicles had proven their importance. When the war ended, that infrastructure shifted into civilian life. Roads expanded, car ownership increased, and the petrol station was born. And it was born as a controlled environment where the company could manage quality, branding, and customer experience, not just a place to buy fuel. Through the 1920s and 1930s, Shell began standardizing its stations. The Shell symbol became more defined. The colors became consistent, and the layout became recognizable. This was brand engineering, not just fuel distribution. After the Second World War, everything accelerated. car ownership exploded, and suburbs expanded. People were no longer living and working in the same place. Movement became part of daily life, and petrol stations became essential infrastructure. And this is where the modern business model it begins to take shape. Because what looks like a fuel business is not really a fuel business. It's a volume business built on controlled margins. Fast forward to today, and a Shell branded station in Kenya is not actually run by Shell directly. The brand is licensed to Vivo Energy. Vivo Energy acts as the distributor. Then a local dealer operates the station under strict guidelines. So when you look at one station, you're looking at 3 layers: a global brand, a regional supplier, and a local operator. Now this is the most interesting part of this whole story. Fuel is not where the real money is being made. In Kenya, fuel prices are regulated and margins per liter are fixed. A dealer only earns a few shillings per liter. That means even when a station is busy, the profit from fuel alone is limited. So the business shifts. Fuel becomes a tool. It brings people in. The real money is made once they stop. Inside the shop, margins are higher. Snacks, drinks, everyday items, and the services like car wash, lubricants, LPG, and mobile money. All this generates stronger returns than fuel. A well-run station can make a significant portion of its profit from these non-fuel activities. In some cases, nearly half. That's why modern Shell stations look the way they do. They're not just fuel points, they are small commercial hubs designed to capture value from every customer who drives in. And once you see that, the entire system becomes clear. From a Shell shop in London to a global network of stations, the strategy has always been the same. Control movement, build systems, stay ahead of where the world is going, and never rely on just one source of profit. Let's pull into the Shell petrol station again. It looks clean, structured, and almost predictable. Cars are moving in and out, attendants are in uniform, and prices are clearly displayed. It feels like a simple transaction. You pay, you fuel, you leave. But what you don't see is that every liter you pump is already controlled before you even arrive. The price is not set by the station, it's set by the regulator. In Kenya, fuel prices are determined by the Energy and Petroleum Regulatory Authority, EPRA or EPRA. Every month, they publish the maximum price at which petrol, diesel, and kerosene can be sold. So the station owner is not sitting there deciding profit margins. Those margins, they're already fixed, and they're small, very small. For every liter sold, the dealer earns only a few shillings. It's just a thin slice that has to cover everything. Staff, electricity, security, losses, everything. So immediately, the illusion breaks. This is a volume business. The only way to make money from fuel is to sell a lot of it. And that is why location is everything. A station on a busy Nairobi road can move 20,000 liters a day, sometimes more. That sounds big until you realize how thin the margin is. Even at those volumes, the fuel side alone is not what makes a station truly profitable. Because fuel is the bait, not the product. Now let's look at how the station is structured. There are 2 main models operating under Shell branding in Kenya. Company-owned, dealer-operated, CODO, and dealer-owned, dealer-operated, DODO. In the CODO, the company-owned, dealer-operated, the land and infrastructure belongs to the company. The dealer comes in to run the business and pays rent or fees. In the second model, the DODO, dealer-owned, dealer-operated, the dealer owns everything: the land, the construction, and the equipment, but they operate under strict branding and supply agreements. Now that difference matters because one operator is trying to maximize return on a rented system, and the other is trying to recover millions invested upfront. And that investment is not small. Setting up a petrol station, it requires serious capital. Land is the biggest variable, especially in Nairobi. Then you have underground tanks, pumps, canopy, drainage systems, and compliance requirements. Before a single liter is sold, millions are already committed. So when the station finally opens, the pressure is immediate. You need volume, you need consistency, and you need cash flow. Because this is another reality that people don't think about. The fuel sitting underground is not cheap. A single delivery, it requires millions of shillings in working capital. The dealer has to finance that stock before it's sold. So when prices go up, it doesn't mean the station is making more money. It means more cash is locked underground. Now imagine this. You buy fuel at a high price, then the regulator lowers prices the next cycle. Now you're selling cheaper than what you paid. That is real risk. So the dealer is constantly balancing stock levels, timing, and cash flow just to stay stable. Now add competition, because that Shell station is not alone. Across the road, there's another brand. Down the road, another one. Same product, same regulated price. So how do you compete when you cannot change the price? You change the experience. You change what happens after the car stops. That's where the real business begins. Walk into the shop. This is where the margins breathe. Snacks, drinks, everyday items. These are not regulated like fuel. The station can mark them up, they can control pricing, and they can adjust based on demand. A bottle of water can make more profit, percentage-wise, than several liters of fuel. Add a car wash, add lubricants, add LPG, add mobile money services, add a restaurant or a coffee shop. Now the station becomes a spending point, and this is where the smartest operators win, because they understand that every car that enters the station is a retail opportunity, not just a fuel customer. That's why the modern Shell stations, they're designed the way they are. Clean forecourts to pull you in, but the shop is positioned to catch you. The services, they are placed to keep you there longer. Time spent at the station increases spending, and spending increases margin. Then the margin, it builds the business. So now let's look at the full picture. We have the fuel bringing the traffic, non-fuel making the profit, and the entire system is only working if volumes stay high and costs stay controlled. Because the costs, they don't disappear. The staff must be paid every month, electricity runs all day and night, security is constant, and maintenance never stops. Even small losses matter. A tiny percentage of fuel lost through evaporation or error, it can wipe out a significant portion of profit. So the operator is managing a very tight system. Thin margins, high volume, high responsibility, and constant risk. This is why two stations that look identical, they can perform completely differently. One is busy but struggling, the other is busy and highly profitable. The difference is everything around it, not the fuel. How well the shop performs, how efficient the staff are, how tightly costs are controlled, and how smartly the operator uses every customer who walks in. That's the real business of a Shell petrol station.